Labour almost broke the internet and the will of most financial journalists in the build-up to what not so affectionately became known as the black hole budget. There were plenty of concerns leading up to the budget, especially around people's investments. So in this video, I'm going to explain how changes to capital gains tax and pensions in particular could impact your portfolio and what you can do about it. Hi, I'm George, Founders Investing Expert. This month we've partnered with Interactive Investor to bring you the latest market news and insights from the past month. If you're interested in more content like this, do me a favour and make sure to like below and subscribe to our channel. Before the budget, it was a guessing game about what would and wouldn't be changed, and this was partly driven by the fact that Labour slightly painted itself into a corner by making statements that it wouldn't be raising taxes for working people, which are typically its biggest levers. So any changes that were going to be made would, have to be on the fringes. Particular worries were about the definition of working people, which kind of led to a lot of speculation that pensions and investments in general would face some changes because of the slightly absurd assumption that people who invest fall outside that bracket. In the end, some changes have been made that will impact investors and pension savers, but it is slightly nuanced and not as extreme as some people were expecting. And even better, there are ways to avoid the worst of these new adjustments. The most notable change is that the rates of capital gains tax, or CGT, will be rising. But what is CGT? Well, at its core, it's a tax that you're supposed to pay if you make a profit from selling an asset. The technical term is disposing of an asset, but personally, I think that's slightly confusing language because it just sounds like you're chucking something in the bin. Basically, if you buy an investment, a property, cryptocurrency, or even a Pokemon card, and it goes up in value, when you sell it, you pay tax on the profit made. So the idea is that if, say, you buy something for £10,000, then later sell it for £12,000, you pay tax on that £2,000 gain. The amount of CGT you'd pay depends on your income tax band, and in the simplest terms, if you pay basic rate income tax, before you'd pay 10% CGT on a gain, or if you're a higher or additional rate taxpayer, the rate would have been 20%. In the budget, it was announced that from 30th of October 2024 onwards, the rate is going to go up to 18% for basic rate taxpayers and up to 24% for higher and additional rate taxpayers. You don't pay CGT if you sell your primary residence. This is called primary residence relief. So you don't have to worry about it if you sell your house in most cases. However, if it's not your main residential home, you might have to pay CGT on a sale. Each year, you have an individual tax-free allowance of £3,000. So you'd only pay CGT on investment profits, say, that are above that £3,000 threshold. Now, neither of those reliefs or thresholds are changing, which does help keep things simple. All that's happening is that you'd pay a higher percentage of tax on any profits that you make outside your existing allowances. Thankfully, there is a way to protect your portfolio and your investments from CGT altogether, and that's by using a stocks and shares ISA. Luckily, in the budget, there were no changes made to ISA rules or your £20,000 annual ISA allowance, or the introduction of total portfolio caps or anything like that. So the ability to become an ISA millionaire is still on the cards if you can invest successfully over the long term. Each tax year, you can invest up to £20,000 with a stocks and shares ISA. And as long as the money and investments are held within that account, which is sometimes called a wrapper, you don't have to pay any CGT on any of your profits. This means that these CGT increases won't impact you whatsoever if you're making the use of your generous ISA allowance. It's really important to try and make the most of these tax efficient accounts while they're still around in their current format, because without this tax wrapper, changes to something like CGT could mean a big hit to your portfolio by having to pay at least 18% tax on your investment profits. Stocks and shares ISAs also have other tax benefits outside of CGT protection. You're also protected from dividend tax. So if any of your investments pay a dividend income, you don't have to pay any UK dividend tax if you're using this account. And also, unlike a pension, if you withdraw money from your stocks and shares ISA, you don't pay any income tax on that money. For example, say you'd built yourself a significant portfolio and you wanted to withdraw £50,000 one year. You'd pay no income tax on that and it wouldn't affect the rest of your income tax for that year. So it's not going to push you into a higher threshold or anything like that. This is why you'll see people in the finance world constantly banging on about how good these ISA accounts are, and they're something that most other countries don't even have. Referring to the CGT adjustment, Myron Jobson, Senior Personal Finance Analyst over at Interactive Investor, says the double whammy of swinging cuts to CGT allowance in April and the rise in CGT rates provides extra impetus for investors to do what they should already be doing, making the most of tax-efficient wrappers like ISAs and pensions, which shield gains and income generated from investments from tax. And if you're like me and you need to do a bit of a Google of what impetus means, let me save you some time. It just means more momentum for something to happen quicker. Okay, thankfully, on the surface, not too much is being tinkered with on the pension front, because if there's one thing that we want stability with collectively, it's probably our pensions. The major change being introduced is that pensions will no longer fall outside of your estate for inheritance tax purposes. Currently, your pension pot doesn't count towards what's called your estate, which means that your family wouldn't pay any inheritance tax, or IHT, on your pension pot. In the budget, the Chancellor announced that from 2027, pensions will be factored into your estate. This is something that already happens with other tax-efficient accounts, like a stocks and shares ISA, but it was an added benefit of pensions that they weren't included in this. The incoming changes mean that it's more likely you could breach your tax-free threshold, called your nil rate band for IHT, because now your pension would get lumped into the calculations. And for most people, your house and your pension will probably be your two biggest assets if you reach retirement. There's no immediate action to take to kind of, protect yourself from this, like you can do by using an ISA with CGT, but it will make estate planning even more important going forward, which could make it more likely that you'll need to get some financial advice or see a financial planner in future to help kind of minimize the IHT burden your family could end up paying if you do build up a sizable pension. The good news with pensions though is mostly that there's no news, because there's no changes being made to pension tax relief or the tax-free lump sums that you can take from private pensions like your workplace pension or a self-invested personal pension, a SIP, when you reach retirement. Make sure you tune in next month, and if you want to check out our review of top trading apps like Interactive Investor, just click the I over in the right hand corner or click here for our latest videos.